Hello, everyone. It's Monday, March 16th, 2026. My name is Eric Wilder here with Fincards. This week's deep dive stock is Adobe. So let's get right into it. Adobe just posted a record quarter, 6.4 billion in revenue, cash flow hitting an all-time high, and their AI first ARR more than tripled year over year, but the stock still dropped. And on that same earnings call where they reported all of this, the CEO who built modern Adobe announced he's stepping down after 18 years. So today I want to talk about what's actually happening here because I think the story is a little bit more nuanced than either side is making it. I spent the week going through everything on this one, the full earnings call transcript, the annual report, the press release, a bunch of supplemental research on AI disruption in the creative tool space. And what I found is a company where the fundamentals are saying one thing and the market is saying something totally different. So we need to figure out which one is wrong. Let's start with the snapshot. If I pull up Adobe right now on Fincards, the stock is sitting somewhere around $250 a share. It peaked at $688 back in November of 2021. So we're looking at a 64% drawdown from the high. But when you look at the actual business underneath that price, it tells a different story. Revenue per share has climbed from about 37 in 2022 to nearly $56. Free cash flow per share went from under $16 to $23. Net margins expanded from 27% up to 30%, and return on invested capital jumped from 21% to almost 30%. And the multiple has just been getting absolutely crushed this entire time. The average price to earnings ratio went from 39 times down to 22 times. So this is the sharpest valuation compression that Adobe has seen since they became a subscription company. Now, one important caveat here, the 10Q for this latest quarter hasn't been filed yet. The financial snapshot that we see on Fincards is what's been publicly reported up through this earnings call, so the latest 10K. Once the 10Q drops, probably sometime in April or in the next couple of weeks or days, the picture fills in. So that's worth keeping in mind as we take a look at this card. Let's quickly explain and discuss what Adobe actually is for anyone who might be newer to this one, because it matters for understanding what the AI question is and why it's so loaded. So Adobe turned itself into a toll booth on the creative economy. If you make content professionally, whether that's design, video, photography, marketing, documents, whatever, you almost certainly pay Adobe a monthly subscription for something. Now, Photoshop, Premiere, Illustrator, Acrobat, Lightroom, these tools are industry standards and have been for decades. So they reorganized recently into three customer groups. You've got one, the business professional and consumers, which is mainly Acrobat and Express. That segment did 1.78 billion in subscription revenue just this quarter. That's growing 15% year over year. Then there's the second, creators and creative professionals, which is the flagship franchise with all the creative tools plus Firefly, their new AI platform that they're building out. And then lastly, they have their marketing professionals, which is the enterprise stack, Adobe's experience platform, Gen Studio, the whole customer experience orchestration business. And that serves basically every major enterprise you can think of. Combined subscription revenue across all this was 6.17 billion in the quarter, up 12% in constant currency. Total annualized recurring revenue hit 26 billion, growing almost 11%. So the business is big, it's profitable, it's growing, it has incredible reach. They serve 99 companies of the Fortune 100 and have over 850 million monthly active users across all their platforms. So that context matters a lot because the question isn't whether Adobe is a good business, because it obviously is. The question is whether or not the business is structurally threatened by AI. That brings us to why the stock is down 44% from the high despite the numbers looking strong. There are really three things converging here, and you need to understand all of them to get the full picture. The first one is that stock photography is dying, and it's dying faster than anyone expected. So Adobe literally said on their earnings call that their traditional stock business saw a steeper decline than they had planned for. And that's management telling you their own forecast was wrong on the downside. Generative AI is replacing stock imagery at a massive scale. Billions of synthetic images are being produced every year now, and there's research out of Stanford documenting how this flood of AI content is devaluing visual assets across the board. The era of paying for stock photos is ending, and it's ending a lot quicker than Adobe had budgeted for. That's a real revenue headwind, and it's the kind of thing that makes people wonder what else might be getting compressed that Adobe hasn't planned for yet. The second fear is the broader AI disruption narrative. So Canva now has hundreds of millions of users and a very, very generous free user base. Midjourney, Runway, and every other major LLM platform are all building creative capabilities, including Gemini with their Nano Banana. The tools that used to require years of Photoshop experience are now becoming democratized and accessible to everyone. So the bear case here is straightforward. If AI democratizes creativity, then Adobe's moat around complex professional workflows gets thinner over time, and their ability to push through price increases on the Creative Cloud subscription gets a lot harder. The freemium expansion that they're doing, which pushed creative freemium users past 800 million, growing year over year, is great for top of the funnel, but it compresses near-term annual recurring revenue by design. So you're bringing in users who just aren't paying yet and hoping that they pay eventually. And the third thing, which I think is actually a big wild card, is what we mentioned earlier, is this new CEO transition, which came totally out of left field. So Shantanu Narayen announced on this very earnings call last week that he's stepping down after 18 years and 100 consecutive earnings calls for him. So I want to make sure people understand the magnitude of what he did at Adobe, because it's one of the most impressive business transformations in the modern tech era. He took over in 2007, made the decision to kill what was the perpetual license model. That was the thing that had built the company to what it was at the time. You bought Photoshop for $700 in a box and you'd own it forever. And he basically said, no, we're moving to a subscription model. So everyone's going to pay monthly. And at the time, the backlash was enormous. Subscriptions were not the big thing yet. There was still the perpetual license for the Microsoft Office suite. So customers hated it. But the stock took a hit. People thought it was crazy. And it turned out to be one of the best strategic decisions any CEO has made in the last 20 years. Revenue went from about $3 billion to nearly $24 billion under his watch. He turned Adobe into one of the most profitable and predictable software businesses on earth. And now he's leaving, right in the middle of the biggest platform shift since that cloud transition. So he's staying on as the chairman of their Adobe board, but no successor has been named yet for CEO. And the board just started the search process. So if I had to make a prediction on who gets the job, I'd put my money on David Wadhwani. He's currently the president of the Creative and Productivity Suite, which means he owns Firefly, the AI product, Creative Cloud, Acrobat, and Express. And so that's the majority of Adobe's revenue and the center of gravity for the entire AI transformation. He's also not a lifer who's only seen the inside of Adobe. He actually left the company and went and ran a company called App Dynamics as CEO, which ended up being acquired by Cisco for $3.7 billion in, I think, around 2017. And then he did a stint as venture partner at Greylock before coming back to Adobe in 2021. So that combination of deep institutional knowledge plus external CEO experience plus control over the biggest revenue franchise makes him an obviously good internal candidate. What's also interesting is that this is actually a much bigger pattern happening across the industry right now. CEO turnover hit a record high in 2025 with over 1,500 departures in just the first 3 quarters of that year alone. And Walmart CEO Doug McMillon said it as plainly as anyone has, he could start the AI transformation, but he couldn't finish it. So the leaders who built the digital era are handing off to leaders who need to navigate the AI era. And that handoff is inherently messy and uncertain. Now, here's the part that I think most people are sleeping on. Adobe's AI usage numbers are actually genuinely massive, and they're growing at a rate that should make you pay attention even if you're skeptical of the bull case. Adobe's Creative Freemium monthly active users crossed 800 million, up 50% year over year. And that includes web and mobile versions of Firefly, Express, Premiere, Photoshop, and Lightroom. And their generative AI credit consumption, which is how they measure actual AI usage, grew 45% quarter over quarter. Not year over year, quarter over quarter. So video generative actions grew 8 times year over year. Audio generative actions doubled year over year. Users are now moving into these AI assisted creations across all the creative processes in Adobe, not just dabbling with text to image. And the monetization is actually starting to follow as well. The Firefly subscription and credit pack annual recurring revenue grew 75% quarter over quarter and crossed 250 million total. Firefly Enterprise, which is combined with Firefly Services and Firefly Foundry, saw new customer acquisition grow 50% year over year. And on the enterprise side, AEP has scaled to processing over 35 trillion segment evaluations and 70 billion profile activations per day. The subscription revenue for AEP and its native apps grew 30% year over year. Gen Studio ARR also grew 30%. Customers with more than 10 million in annual recurring revenue grew over 20%. Then there's also something that doesn't get nearly enough attention on the Adobe story, and that's the content authentication play. Adobe actually co-developed what's called the C2PA standard, which is becoming the industry approach for verifying whether images are real or AI generated. Other companies like Leica already have a compliant camera on the market, and Sony, Canon, and Nikon are all expected to follow. So in a world that's absolutely drowning in this synthetic content, or what people call AI slop, being the company that builds the infrastructure layer for trust is actually a real competitive advantage and a moat that they're building that no AI native startup can easily replicate. In fact, they may end up having to adopt it themselves. And then there's the platform strategy. Instead of trying to fight every AI platform, Adobe is embedding directly into them. They launched Acrobat and Express for ChatGPT, and they're building similar integrations for Copilot, Claude, and Gemini. The idea is that every new AI platform becomes a distribution channel rather than a competitor. It's a smart play, in my opinion, if they can execute it. So Fincards, us here, we're not here to make a call for you on this, but we are telling you what's worth watching and giving you the information so that you can make an educated decision yourself. So for the bulls to be right, we think that Adobe's AI usage metrics need to convert into real subscription revenue over the next 2 to 4 quarters, and that freemium funnel we talked about needs to drive meaningful upgrades. The enterprise pipeline needs to keep accelerating, and whoever gets that CEO job needs to maintain strategic continuity while actually speeding up execution. Then on the other hand, for the bears to be right, the stock photography decline could be a leading indicator of broader pressures across the creative revenue business. AI native tools keep gaining share at the low end faster than Adobe can upsell at the high end, and the CEO transition disruption is just messing up the execution at exactly the wrong time. So the single number worth tracking is total Adobe annual recurring revenue. They're guiding 10.2% for the fiscal year. If that accelerates through the back half, the current valuation looks really interesting. If it decelerates, the compression probably isn't over, and not a recommendation either way, just the numbers that tell you which version of the story is actually playing out and what to watch. Again, the 10Q hasn't dropped yet as of our recording this, but when it does, the snapshot updates and the picture might fill in just a little bit, although the earnings report and the conference call did provide quite a bit of detail. We also have a fully written breakdown of this with some links to some of the sources that I've mentioned on our Substack, but I will also link some of the sources in the description down below. This is our first video. If you're here till the end, we really appreciate it. I hope you got some use out of this. I'm sure our videos will improve over time, but right now it would really be very meaningful to us and help us out a lot if you could subscribe, like this video, it'll help with the algorithm, and I'll see you next week.